Good afternoon, everyone, and welcome to our Treasury Strategies webinar this afternoon about creating value from your account analyses. I'm Kathy Gregg, and I'm joined here in Chicago this afternoon by Tony Carfang. We are both managing directors at Treasury Strategies, a division of Novantas. For the last 3 decades, of those of you who don't know us, we have been providing advisory services to corporate treasury and now also some very useful treasury support tools, one of which we'll talk about today. If anyone has questions during our presentation, there's a little Q&A button in the center bottom of your screen. Feel free to click that, type us a question, and we'll try and answer your question as we go through our conversation this afternoon. We'll also send a copy of this presentation deck as well as a recording of our session to everybody who's on the call. Let me go over the agenda just a bit, and then we'll dive in. So our group here today is insurance and finance-related companies, money-intensive kinds of businesses. We have quite a few of your segment kinds of companies in our in-depth customer base, and we have some segment-specific information that we're going to review with you to start off with about services, fees, and benchmarks. And then we're going to switch into some specific examples of how in-depth can create opportunities for you in your account analyses, specifically saving time and saving money. Several ideas there. And at the very end of the session, we hope you'll stay on till the end because we have a special offer that we want to make to you. So we'll give that to you right at the end. And now I'm going to turn it over to Tony to start talking about the treasury and banking landscape for insurance and finance companies.
Thank you, Kathy. So we have, as Kathy mentioned, a large number of insurance and finance or financially intensive companies in our in-depth database. And each month, these companies are uploading their account analyses and getting back a very attractive set of reports to help them better manage their bank services, their earnings credit rates, their balances. Many of you on the line here are doing that. The sample of users is actually so large that we've been able to come up with some industry-specific findings and key insights that are quite valuable, and we want to share them with you this afternoon. And as Kathy mentioned, these are a number of ideas that will save you time and save you money. So let's begin with the total wallet, the total spend. And among the insurance and the financially related companies in our database, we actually see, as you can see on this pie chart, the distribution of services that you all are buying from your banks. Now, I'd like to point out this is very different from the typical corporate user of bank treasury management services. So, and I think that kind of highlights how you're from a bank relationship management standpoint. The insurance and the financial industries are different, and in many cases, banks have separate account groups or relationship management groups to handle that. So if we look at this pie chart, we find that the largest spend, 29%, is on wire transfers, followed by disbursement services and information services. So more than 2/3 of all of the money that you're spending with your banks are going to disbursements and wires, and then information attendant to that. Lockbox is only 8%. That's very different than what a banker typically sees when a banker is working with other industries. Now, when you look at this makes sense. This industry is dealing in higher denominations, and because you're dealing in financial products, immediate availability calls for the use of funds transfers. And obviously, you need information around those transfers to manage that efficiently. You need to know when the wires are arriving, what the balance levels are. So this might be something useful for you to take a look at as you look at your own spend to see how well you're conforming to what our insurance and financial clients are dealing with at their banks. Now, let's move into some specific services where we see some very interesting findings. And the first one we'd like to talk about is Lockbox. Now, while this represents only 8% of the total spend, it does represent some of the highest volumes here. And let's first explain how these charts work here, because within NDepth we actually show pricing at your level and across the entire market at various volume levels. So if you look at the horizontal axis here, we're looking at volumes, and the vertical axis is price. The red line is the market median price at each of those volume levels. And the blue line is the insurance and finance industry price at those volume levels. A couple of interesting things. You see how sharply downward sloping and to the right these lines are. What's fascinating about that is, most of us tend to think of price as a point and not a curve. Price of a wire transfer is $12 or $20 or whatever it happens to be, or a lockbox item is 52 cents, whatever you see on your account analysis. But when we look at these on an all-in basis, we actually see a nice scale curve here, and we're going to talk about how important that can be for you as you manage your treasury management services. This also shows how the costs scale as you add volume, and makes quite an argument for concentrating your volume at fewer banks rather than spreading your volume at many banks. Many of our clients say, well, we have a lot of banks in our credit, so we have to spread our volumes. And that makes a lot of sense. And for relationship reasons, you may well want to do that. But what these lines show is when you do that, you're actually incurring a very high cost because you're moving upward and to the left when you fragment your business versus downward and to the right when you consolidate your business. Now, the other concept we'd like to introduce here is what we call product families. When you get your account analysis statements, you're getting dozens and dozens or hundreds and hundreds of different undecipherable line items that add up to your whole bill. And what we do in NDepth and what we do at Treasury Strategies for all of our consulting clients is roll those up into logical product families. Within NDepth, we have nine standard product families, and we benchmark across those, but our clients are able to customize those and have as many product families as you'd like. But the important thing is, we bundle together, like in Lockbox, the per item processing charge plus the monthly lockbox rental plus the maintenance fees plus the image charges and the scanning charges, and all of those to get an all-in price, which is actually what you're really paying for all of your items at the bank, and not the 38 cents that shows up on your account analysis under the Lockbox per item charge. Let's take a look at this chart because it's really fascinating. And the first thing I'd like to point out is that the blue line, the insurance and finance industry line, is well below the red line, the market medians at all volume points, which means that as an industry, you're all paying less for these services than a typical company that we see in our database. Now, when you think about it, that makes a lot of sense because a lot of your lock boxes are conforming very precisely to the bank standards. They may be scannable or OCR readable or whatever, but allows for much more efficient processing. And sure enough, that's getting reflected in the price. However, that doesn't mean that we should all smile and pat ourselves on the back and go home. There's actually a lot more to read into here, though. So if you were to look at the prices at the 10,000 item per month level here for Lockbox, the blue line, your line, intersects the 10,000 vertical line at 90 cents per item. So which means, as an industry, at a volume of 10,000, you're paying 90 cents an item all in for your lockbox services, versus where the red line intersects, which is everybody else in our database, at $1.29. That's actually a pretty significant difference. And as you look at your own account analyses, if you're closer to the $1.29 than you are to the 90 cents, there may be ways in which your lockbox is structured where you could actually save some money here, because it's clear that the banking industry does reward you for coming up with a standard clean lockbox. Now, the other thing I'd like to point out, if we look over at the 100,000 item per month point, remember we said you're paying 90 cents at 10,000 items per month. At 100,000 items a month, you're paying 24 cents. Talk about economies of scale and talk about the value of consolidation here. So clearly, almost more so than most other product lines, there is a huge value in consolidating your volumes. Now, let's look at another product here, and we see somewhat of a similar pattern in terms of the scale economies here in electronic payments, which would be your EDI and your ACH payments. Again, the pricing is low and it scales because of the high degree of automation. However, this time, the blue line is above the red line. That means as an industry, you're paying more than other companies are paying their banks at identical volume levels. Now, these are very close. So, we're not suggesting that there is a problem here, but this is something that each of you ought to drill down in to see if you can't get back to the market median or even below. Okay? And again, we see the same scale dynamics.
Tony, we have one question before we switch to ECR. Someone's asked, what is the calculation for price on those charts? And I thought we should answer that. And that is, these are the all-in prices that we observe in our database of NDepth clients. So we have over 100 companies using NDepth every month. And these benchmarks are calculated based on their actual observed all-in prices. We'll talk about that concept of all-in prices in just a second.
Good. Thank you. Now, let's move on to earnings credit rates, which is the value that you're getting on the balances that you leave on deposit at your bank. Now here, let me first explain. We're showing market percentiles. The red line is the median earnings credit rate that insurance and financially related companies are receiving at the deposit levels you see across the bottom. The blue lines represent the 25th and 75th percentiles, respectively. So as you look at your earnings credit rates and plot them at the balance levels, obviously you would like to be above the top blue line and getting the best earnings credit rates of anybody in the industry. Half of all of the observations in our database for insurance and finance companies are between those two blue lines, between the 25th and the 75th percentile. A quarter are above the top blue line, a quarter are below the bottom blue line. If we look at a $10 million balance level at a bank, we see the red line intersects at 71 basis points. So the median ECR that the insurance and finance companies in our database earned in the second quarter was 71 basis points. Notice the range, though, goes from 53 to 93 basis points. That means that there's 40 basis points of what might be fairly straightforward negotiating opportunities here. That's actually a fairly wide range when you're getting into higher balance levels. However, these numbers, 71 basis points at the median, it's interesting because that's 25 basis points higher than we see across companies in the rest of our database. So the insurance and financial industries have negotiated or are receiving higher earnings credit rates than the market median earnings credit rates, but below other money market rates, and this is key, and this is sort of where the rubber meets the road here. At $10 million on deposits, I said the median was 71 basis points. Now, banks also charge you a balance assessment fee or regulatory recoupment fee, which for your industry averages 18 basis points. So your net, the blue line here intersects at 53 basis points. During the second quarter, had you invested that money in an institutional money market fund, you would have earned around 180 basis points. That difference is 127 basis points of opportunity cost for you. Had you invested that $10 million in a money market fund rather than a bank earnings credit rate, you would be earning an extra $127,000 per year, which really adds up. What that means is these are real opportunities. This is data from actual Treasury Strategies clients using our in-depth service and databases. So now we're talking about saving time and saving money. Kathy's going to talk about some very specific examples here.
Okay, so how does NDepth help highlight opportunities for you? So how does NDepth help highlight opportunities for you? First of all, NDepth helps to standardize and aggregate your data in an automated fashion. Excuse me, many of you probably use a spreadsheet to calculate some numbers every month. Some of you might have a tool, but any of you that are trying to do this yourselves in any kind of a quasi-manual fashion, no, it is very, very time-consuming and difficult to do. NDepth takes away the part of this activity that is manual number crunching, and it does it for you in a very automated fashion. So it produces reports like this dashboard. Very good for management reporting, by the way, because this is, the kind of thing that we like to show our management. What we've got in this example is a complete profile of all my banks, all 5 banks I'm using, the balances, ECRs, total services spent this month. And I've got some wallet share data down there too, so I can compare the percent of my credit provided by each bank, the percent of services spend going to each bank, and the collected balances at each bank. I've also got some nice time series information. Again, good management reporting lets me look at a couple of key metrics in a visual sense. My service charges over time, my balances, and the average calculated ECR, all very interesting to look at and say, well, you'd expect to see them holding fairly constant and fairly flat from month to month, but there are probably circumstances that cause your service charges to move. Maybe you've got somewhat cyclical activity or renewal periods that would generate a lot of transaction business. Your ECRs, you don't want to see those flat over a long period of time, do you? You want to see them going upwards. So are they doing that? Those kind of things. Then we've got some more granular information about your actual product spend that is very interesting. And some of these things are our customers using NDepth tell us these were the things that were so hard to do manually. Tony mentioned the concept of product families. This is a key foundation of NDepth. We've defined 9 product families and mapped all 2,600 potential bank codes, service codes into these 9 product families, and have used artificial intelligence and machine learning in the design of our product so that as your electronic account analyses, 822s, or PDFs are read into the product, they are automatically mapped into the product families. And you get reports that let you see visually and in a tabular way what's going on at every one of your banks. So in a case like this, we're focusing on pink, yellow, and green, basically. Those are our 3 biggest spend areas. If you look down in the table, more than half of our spend is on funds transfer in this example company. The other 2 big areas are electronic payments and Lockbox. So if you're managing this company's treasury, if you're managing those 3 biggest spend areas, then you're doing a good job of managing things month to month. Tony has a question
Yeah,
here.
so, and Kathy, I think we ought to point out, whether you're using a tool or not, what you saw in the last 3 slides, represent a dashboard that we recommend that all of our clients implement every month and show to their management. You have 3 slides that really show you what your spend is and what your relationships are with your banks.
Good. And another way that NDepth helps you save money is it really lets you compare apples to apples pricing at your banks. Now, from our point of view, it's no good to compare line items. We've got to get the data into the product families. We've got to count the volumes, measure the volumes correctly, and then dividing one by the other, we come up with what we call your all-in unit price or effective unit price. So just in this little slice I've got here on the slide, I've circled the all-in unit prices for wires at the 4 banks that this company uses wires at, and they range from about $13 a wire to $21 a wire. It's a pretty wide variance. If this were my set of account analyses, I'd be saying, hey, those guys that are at $21 or $17, what can I do to impact those high prices? What are my options there? Maybe I can move some business. Maybe I can negotiate some better prices. Maybe I can look at what I'm buying and just see if I need everything in that product package. But NDepth is giving me the data to do this comparison and ask myself what my options are. I can drill down into it. Oh, and by the way, before I start negotiating price with my banks, let's take a look at where they are in terms of the benchmarks. So that graph down in the right-hand corner shows my 4 banks. Those are the gold stars are my 4 banks against the wire transfer price curves like the one Tony was just showing you. And I can see that those 2 banks out on the far right, those are my highest volume banks. I'm over 1,000 wires a month at each of those banks. I am well above the benchmark, the 75th percent line. So yeah, I think I might want to try and do something about this. NDepth is showing me this so I can see where to put my time and attention. Wow. Okay. Oh, or maybe I would say, if I'm spending that much on wires, maybe I should think about switching to ACH. Good thought. All right, another way NDepth can help you save money is by focusing your attention on variances each month. We show variances at a unit level, so per item. Did your per item volumes vary by more than a certain percent this month versus last month? At the actual average, the price, did your price go up or down this month versus last month? And then your total spend. And all you really have to do in a report like this is look at the red and green boxes and say what's going on. Here's an interesting one down at the bottom, the outbound wire line at Mustang Bank. In May, I did 232 outbound wires circled there. In June, I did 521. That's kind of a big increase, more than like almost 300 wires more. And if you look at that and you don't know instantly what was going on in the company that caused you to need 300 more wires, definitely something to look into. And oh, by the way, that cost you $6,000 extra. Not saying that's going to happen month after month, but if it were, you'd be looking at a big increased bill. Something to look at. Finally, reviewing your earnings credit is a way that NDepth can help you save money. And I think Tony's gone over this probably sufficiently that we don't have to dwell in it. But again, looking at your own banks arrayed on those ECR price curves, we can see that one bank is definitely an outlier. That bank is definitely down below the others, down below the 25th percent line. And oh, by the way, it's also one of your highest volume balance banks. So maybe it's time to negotiate a better ECR with that bank. Maybe they're just a little bit slow at raising their ECRs relative to the Fed price hikes. Maybe you want to think about trying to move those balances into a money market fund and getting some real interest. Maybe you could use that money to pay down your short-term debt instead. Anyway, it highlights opportunities for you. Okay, and finally, I just wanted to share a couple of testimonials from other firms who are using NDepth that are in the sector we're talking about today. Patrina from Navistar and Sam from Rockefeller Group. Patrina highlights the fact that it's quick and easy to provide NDepth with data. I don't want to discount this because any of you who are doing this daily or monthly yourselves, you know it takes a lot of time. And when I tell you it's so easy with NDepth, you think I'm exaggerating, but literally I'm not. We can read account analyses automatically, and our artificial intelligence and machine learning know what to do with that data once they've got it. It is pretty simple to set up an in-depth profile for you, and putting the data in is as simple as dragging and dropping PDFs or EDIs. Patrina likes the dashboard. She loves the variance information because it focuses attention. And she mentions that the all-in unit price really lets her do apples to apples comparisons. Sam's in a different situation. He only had one primary cash management bank, so he couldn't do self-benchmarking like some of you can. You know, you compare Lockbox prices at your Lockbox banks, Yes, you wish you had benchmarks, but at least that's self-benchmarking. He couldn't do that. So he was thrilled to have real benchmarks for the first time. He loves having conversations with his banks when he goes in and he feels better armed with data. And he talks about sharing this information with his management. Not everybody wants to do that, but they've done that at Rockefeller, and it's been very productive. So those are some ideas for how NDepth helps you save time and money. Tony, what's the big takeaway here today?
Well, we're going to seize the day, carpe diem. We have a great opportunity that we'd like to share with you. We'd like to offer all of you on the call today 6 months free use of our in-depth service, a 6-month free trial. This is a special offer for the insurance and finance industries, where if you sign up by September 15th, we will let you put up to 5 U.S. banks at the summary account analysis level and provide you with 6 months free use of the service. No cost, no obligation. We are certain that once you try it, you will immediately get benefits. You'll be saving time and money, and we know you're going to love the service. NDepth, unlike other services that you might have seen, can read electronic PDF files as well as EDI files. So all you need to do once we have you set up here is simply drag and drop your files into the portal, and voila, you have your reports. If after 6 months you don't want to continue using this, there's no obligation whatsoever. In fact, during the initial sign up by September 15th, we don't do stuff like ask you for credit cards or anything like that. Simply call Jill. To take advantage of this offer, call or email Jill Salgrad at Jill_Salgrad at treasurystrategies.com, and she will walk you through a very simple setup. And again, we're able to do this because of the latest technology and machine learning we have, where we can simply drag and drop your PDF and EDI files and automatically map that into your banks, into the service codes, into the product families. So see for yourselves and start saving time and money today. Jill's available to take your call or receive your email this afternoon.
All right, so thank you for joining us this afternoon. We really just want you to be able to tap into the value that you can get out of your account analyses through using NDepth. It is not a big effort to get signed up. It is not a big effort to get set up. Now, keep in mind, we're talking about doing this at the summary level, and many of you, especially insurance companies that have a more complex structure, were you to use this on an ongoing basis, you'd want to have some account hierarchies represented. You'd want maybe your subsidiaries each handled separately and then rolled up to the parent company or something like that. All we're talking about for this offer is looking at things at a summary level. So maybe we could pick one of your divisions and look at it separately. But to do it at that level is a very simple setup process. So you're not investing a ton of your time to be able to see what a product like this can offer you in terms of value. So bankers, I also want to shout out to you for a second. We're seeing a lot of interest in this from this industry segment. Feel free to tell your customers about it at a certain level, this could make your lives much easier as your customers become far better informed about what they're buying and how they want to allocate their business. They're going to be less likely to be looking for nickels and dimes on the floor than they are thinking about strategic decisions about how to allocate their business. And that's good for everybody. So bankers, give us a call if you'd like more information about this, if we can help you with some of your customers. Again, feel free to contact me or Tony. And of course, contact Jill if you're interested in finding out more about this. Thank you so much. Bye-bye.